It's almost been exacerbated by the issue in Russia and Ukraine with commodities, and it's almost an economic war versus a traditional war, in the sense that the West has placed all these sanctions on Russia, and now we're seeing counter sanctions from the Russian side, and it's almost creating a commodity war, and commodity prices are on the rise, which has a cascade effect, as I said, at the grocery store and the pump for us as consumers. So I don't see that changing overnight. And ultimately, that's probably one of the most important reasons that we can potentially see a rising gold price. And we also saw comments from Goldman Sachs that if they see inflation persist at 4% or higher, which is double where we are right now, they're predicting a $2,500 gold price for the end of the year. And I would certainly support that argument as well.
Searching for greatness in a sea of the dying and shameless.
Hey everybody, this is Rob Keynes with goldsilverpros.com. We have a very special first-time guest on the program. It is Scott Eldrige, who's the CEO of Canagold Resources, who's joining us to talk about his projects that the company is working on, as well as his views on the gold market and why he got involved in the gold sector in the first place. Scott, how are you doing today?
I'm excellent, Rob. How are you today?
I'm doing very, very well. I'm interested really in your project, and we'll get to that in just a moment. But just to frame the discussion for the viewers, we've had a lot going on, basically since 2016, since we had a recovery in the gold market. So about 6 years of gold doing pretty well. We touched maybe a month ago on the all-time high for gold. So gold's doing very well. Silver's doing very well. The precious metals are in a bull market. And it seems like there are a lot of catalysts and drivers for that. A lot of it has to do with geopolitical scene, but I think a lot of it also has to do with all these different alternatives for money with Bitcoin, things like that, and people talking about, what are our currencies. What's your view, Scott, from your perspective, the last 5 years on why gold has done so well?
Right. Well, if we look at, say, more recent times, we're starting to see more discussions about gold and investing in gold and even gold equities now sort of on the main street versus just Wall Street. And the reason for that is just what's going on in the world today, as you described. There seems to be increased rampant inflation, which started in the US and has migrated around the world now. And central banks are attempting to curb that by raising interest rates. But we look to the actual real interest rate, which are significantly in the negative right now, with no signs of changing, which historically has been very positive for gold. And then we also look to what's going on in Russia and Ukraine, potential discussions on, China, Taiwan. There's geopolitical unrest around the world, and particularly with the Ukraine situation, that's putting bottlenecks around general commodities. Most people are unaware, but Russia is the largest commodity producer in the world. So that's obviously going to have impacts that come in at the consumer level, which we're seeing in the CPI right now. With high inflation. So a lot of what we're discussing right here are positive for gold as of today. And these have been positive for gold in the past. And if we look at gold as a specific investment, investors are looking for sort of spreading risk, portfolio diversification. I think for every mom and pop investor up to central banks, institutional investors, gold and gold equities arguably have an important part to play in our portfolio, and we should all have a certain allocation in there.
Yeah, I agree with you. And there's a lot of reasons for interest in gold. You summarize them very well. Probably the most salient point from an analyst perspective, and my perspective, is the negative real interest rates. When you look at the inflation we just had an 8.5% CPI print here in the U.S., the highest since 1981, dating back to when I was a kid, in a much different time in the U.S. And the producer price index, I think, came out at something like 11 or 12%. So high prices and not great interest rates on investment. So that what that translates to is negative real interest rate. And in negative real interest rate, that tends to propel gold over history probably more than any other single metric, I think, is people say, okay, well, if we're earning negative interest on our bonds and our safe investments, where do we go? And the place people go to typically is gold, and to a lesser extent, silver. In your opinion, Scott, do you see those inflation pressures easing anytime soon? I know you guys have it up in Canada as well. Do you think that that's going to turn around, or do you think that that's more structural? We're going to be living with that for a little while.
Right. Well, the discussion on inflation has mostly sort of been towards a term that people use called transitory. But I would argue that it's not transitory, nor is it permanent. It's something in the middle. So for the next few quarters and probably for the next couple of years, there's no evidence to suggest that this 8.5 inflation rate is going to drop to, say, 2%. Which has a direct knock-on effect to, what is the real interest rate. And as consumers, we see it at the gas pump, we see it in the grocery store, and we talk about prices rising, which is more anecdotal. The real underlying reason is, you talked about in your original question, what's happened over the last 5 or 6 years. We've had massive QE, we've had massive currency debasement. Rick Rule even goes to the extent of calling it counterfeiting. But there's much more money supply in the system right now, and we haven't seen the global economy grow at the same rate that the monetary supply has grown. So we've created this systemic issue that was bound to have inflation, and people seem surprised that it's actually happening now. It's almost been exacerbated by the issue in Russia and Ukraine with commodities, and it's almost an economic war versus a traditional war, in the sense that the West has placed all these sanctions on Russia, and now we're seeing counter sanctions from the Russian side, and it's almost creating a commodity war, and commodity prices are on the rise, which has a cascade effect. As I said, at the grocery store and the pump for us as consumers. So I don't see that changing overnight. And ultimately, that's probably one of the most important reasons that we can potentially see a rising gold price. And we also saw comments from Goldman Sachs that if they see inflation persist at 4% or higher, which is double where we are right now, they're predicting a $2,500 gold price for the end of the year. And I would certainly support that argument as well.
Yeah, I agree with that. And I think from the demand perspective, we talked about some of the things in which people would demand, more gold and put it in their portfolio. We see the central banks doing it, net buyers since about 2010 timeframe. But if you look at the supply side, we also know that we're running into a supply cliff. And I mentioned this on my program over and over again. CRCUF Capital, 𝙂𝙊𝙇𝙍 does a lot of research, and he has a chart out which shows that basically, in terms of proven and probable reserves in gold, he sees us hitting a cliff about 2028, 2029, to where the world just doesn't have these big known reserves of gold anymore. And not only that, Scott, what I see is some of the bigger guys are having trouble finding good, large, high-grade gold deposits. It's now more disseminated across many projects. And a lot of the junior explorers and developers are becoming more important to the field because they're the ones that are really finding it. And they're not necessarily finding, 100 million ounces of gold. They're finding smaller projects. And I anticipate maybe some more consolidation from a mining perspective in the industry, but also more value put on the guys that are out there, boots on the ground, looking for it. So I know that you have a lot of experience in finance. Why gold for you? Did you see this trend in terms of the supply side for gold? Was that provocative to you, or why did you get involved in the gold industry?
Right. Well, as a child, I was always attracted to the mining industry because my father used to work in the silver mining industry up in the Yukon here in Canada at United Keno Hill Mines, which is now another public company called Alexco Resources. So we always had sort of dinner time chats about the mining space, more about silver and precious metals, which obviously includes gold. And one of the reasons that I was so attracted to gold is, I consider myself a quant. I just love to crunch numbers, is that gold is sort of a double-edged sword where it can act as a commodity, but it also is a tangible asset, which no other sort of commodity has that specific attribute that makes gold very unique. So that's sort of the cumulative reasons that sort of brought me where I am today. Just a fascination with the mining business and gold as a metal.
Yeah, so talk a little bit about your company, Canagold. Give us a little bit of the history of how Canagold got started, how you got involved in the project, and as well a little bit about the assets that you guys have both in Canada and in the U.S.
Absolutely, Rob. So Canagold, our flagship asset is called New Polaris, and it's located in my home province of British Columbia, northwestern corner of the province. And it is a brownfield site. So there was production here up until 1951. And our founder and chairman, a gentleman named Brad Cook, that many people are familiar with his name. He's been in the business 40 years, a geologist. He's also the founder of another company called Endeavour Silver. And the way that Brad and I met is I used to run my own merchant banking firm, and I would raise money out of mainland Europe for him, for Endeavour Silver. And then he offered me the opportunity to come in and become the CEO of this company about 3 years ago. And I was very attracted to be involved in this company, first and foremost because of Brad, but secondly because of the asset that we have. So we have a million ounces, all NI 43-101, and we have a grade of 10 grams per ton. And this asset is very unique given its high grade. And to put that grade into context, if this were a mine again, it would be the 6th highest grade gold mine in Canada and the 11th highest grade gold mine in the world. So we all know the proverb, grade is king. It gives you a lot of margin for error. That proverb absolutely resonates true on this project. Very high grade and also very high margin.
And we're talking about the New Polaris project here, correct?
Yeah, that's the map there. So we're northwestern corner of British Columbia. This is a very mining-friendly part of the world, both on the Alaskan and the BC side. There's a number of commercial and placer mines in the area, and generally the communities here, they're very supportive of the mining industry as long as everything is done to the highest ESG standard, which we of course do. And we're in a development stage combined with still an exploration upside to our project, which is fairly unique as well, where we have a fully defined million ounces with a preliminary economic assessment, which we did at $1,500 gold. The numbers are very, very robust, so they only look better at current spot prices, which we've been talking about. And the next step for us would be to move forward into a feasibility study. But in combination with that, this is a mesothermal high-grade gold system, which can often go for great depths. We've only drilled it to 600 meters, but comparable deposits can go for 2 kilometers. So we still have that blue sky component to the project here as well. So we're really excited about what we're doing at New Polaris, Rob.
So let's recap some of what you said. I want to recap some of these figures for people, which will be, pretty astounding. It's very rare to find a mine today that's 10 grams a ton. Correct. That you guys have, and to find, 1 million ounces drilling down, you said 600 feet or 600 meters? 600
meters is the maximum depth so far.
Yeah, that's really good. Now, a couple of questions for you on that. Are you going to be able to mine some of this at surface? Is a lot of it going to be at depth, or what? Do you have an idea of what the actual mine would look like once you get to that point?
Right. So the previous production was all underground, and that's how we would move forward as well. The project is very amenable to underground mining, which is actually better in terms of the surface footprint compared to a large open pit. So our surface disturbance is very minimal. And our all-in sustaining cost, to chat about that, is $530 an ounce, which you typically don't see on open pit projects. That kind of costing you only see in high-grade underground gold projects.
Yeah, that's phenomenal. I want to put up on screen just the resource that you guys have. Kind of walk us through the resource there, and then also talk about maybe some blue sky potential, because you said this could go down at depth. Have you guys done additional research to what the depth could be?
Absolutely. So this is all NI 43-101. So as it stands right now, our resources are about half in the indicated category and half in the inferred category. And what we've been doing for the last year on the project is we've drilled 30,000 meters, primarily focused on infill drilling the inferred, just simply to tighten up the drill spacing on the inferred portion to move it up to that measured and indicated category. Because once we do a feasibility study, that would become the proven and probable reserves in our actual mine plan. So that drilling has gone really well. If you look back to our news releases, we've had multiple significantly high-grade results, and we will continue to see that, where we've got about 15 assay results recently back from the lab that we need to publish news releases on. So watch for that in the next couple of weeks. And we're pretty excited with these results. And then in terms of the blue sky potential, just to clarify, Rob, so the maximum depth of the current resource, the 1 million ounces, is only 600 meters. But we've done some recent drilling that's now extended that into the 700, 800, even 900 meter vertical level of the deposit. And we've hit mineralization. We've hit grade over width that would fall within our mine plan parameters. So the base case mine life on the project is 8.5 years. But we certainly see this as being a generational type asset, where there is certainly a blue sky component to increase the longevity of the mine.
Yeah, I want to put something up from your presentation. This is Polaris at depth, and you talked about that. Talk about a little bit about the type of deposit. Maybe you can a little bit about the mineralogy. But do you have there been similar type deposits in the past worked by other companies in which you could see this go down significantly deeper than what you guys have explored so far?
Yeah, that's absolutely correct. So you don't need to be a geologist to get the gist of this. This is classified as a mesothermal gold vein system. This type of deposit is seen quite commonly in the Red Lake camp of Ontario. But one of our neighboring deposits, the Kensington mine in Alaska, is also a mesothermal system. Fosterville, which is owned by Kirkland Lake in Australia, would probably be the most famous mesothermal system to talk about. And they share a number of characteristics. They're typically high-grade underground veins that see excellent continuity in terms of grade and mining widths. But what really stands out, as you're showing here, is the potential vertical depth that they can extend to. So you can see New Polaris in the middle there. That's only 600 meters vertical, whereas analogous deposits, and these examples are all in the Red Lake camp of Ontario within Canada here. They've gone for depths to 1,000 to 2,000 meters. So typically what you would see in these types of deposits is you would have an 8 or 10 year mine life with very positive economics that encourage you to go build and operate the mine. But once you enter, say, year 5 of the mine life, you still have 10 years of reserves because you've continued to drill it out at depth very successfully. So we see no evidence here that New Polaris would not fit the example of these other analogous deposits.
Yeah, I just want to show one more slide from presentation, because I think this, at the end of the day, if you're an investor, a lot of factors matter. Management matters, and you mentioned Brad's experience at Endeavor. You mentioned, district. You're in basically a tier 1 district, but it's the grade is really king, and you guys are sitting at a really great grade and a much better than average all-in sustaining cost. At least, early thoughts on what that could be. Explain how the economics of this could really help out investors, especially in a rising gold price environment.
Yeah, absolutely, Rob. So as you alluded to earlier in the conversation, with any mineral, the production is largely skewed to these significantly large bulk tonnage open pits. So if you look at the average grade in the gold industry, it's about 1.35 grams per ton. And that gives you sort of a direct function as to what is the industry average cost. So depending on what analysts you follow, it's somewhere between $900 and $1,100 an ounce, because these are bulk tonnage, essentially what we call dirt moving operations. And then a small portion of the industry production is high grade gold mines, and they're not all the same, of course, but typically a high grade underground gold mine can deliver the best margin because they have the lowest cost. And that's exactly the case for New Polaris, where our grade, and this is, by the way, the diluted grade, so this represents head grade to the mill at 10 grams per ton, is 7.5 times the industry average. So it's pretty simple. We just have to move less material to get the same amount of gold, and therefore we have a lower cost. And, if we look to the potential sort of M&A audience for this asset, out the gate, you could ask, what's an exit strategy here? Well, we could finance this and build it ourselves. It has a relatively low capex, but it's also an asset that would cater to strong interest from small to mid-tier producers, where we see this producing 100,000 ounces at very high margin, as you said, in a tier 1 mining jurisdiction. And I think, if we go back to the whole M&A topic, during COVID, a lot of M&A activity was sort of prevented from coming to fruition because it was challenging to do site visits, which ultimately you have to do before you transact on any type of an M&A transaction. So there is a lot of pent up demand from the producer side. And as you also alluded to earlier, the replenishment of reserves from the producers has not happened over the last several decades. So the producers are forced to M&A to acquire development stage projects just like us in order to sustain their production profile. And there's underinvestment from the producer side, but they do turn to companies like us to fulfill their pipeline to sustain their reserve model.
Yeah, and they're going to do it basically on three main factors. Of course, it's going to be a bunch of them, but it's going to be cost and grade, right? It's going to be how much they can produce a year and what your reserves are. I think from those three aspects, those three data points, you guys have put yourself in a good position, sort of be at the front of the line when the majors come calling. So, from your perspective, do you suspect that they're going to start, knocking on your door for that? Or do you feel as though your shareholders, investors really want you to build this mine yourselves and run it yourselves?
Well, we've got great optionality here, Rob, so we can do both. From my experience, when a developer puts the for sale sign on the lawn, that can often be the kiss of death for the share price because there's no commitment to advance the project. So we will commit to building this and financing this. We have great shareholders, by the way, led by the Sun Valley Gold Fund out of Dubai, Eric Sprott, the Rougher Gold Fund. So we've got all the right names in there that are fully supportive of us to move this into a build. And if somebody comes along that path and offers the right premium, the board would certainly take that to the shareholders. So we're just feel we're in the driver's seat here in terms of the optionality and definitely multiple exit opportunities for our shareholders and future shareholders.
So last question I want to ask you today, Scott, on your project is, what type of news flow do you expect to have this year? What are next steps for Canagold? You've got this resource. Are you going to continue to do some additional drilling, or what's the story for your company?
Over the last 10 to 12 months, we've drilled about 30,000 meters, as I mentioned before. That's spread over about 54 holes, and we've only released 37 out of those 54 holes. And the assay labs have been a little backed up here in British Columbia, as people know. So we still have a number of results to release from the current drilling. And in addition to that, we still have 2 rigs on the site that are just waiting for the snow to thaw, and then they'll commence drilling again in June. So in terms of catalysts, watch for some high-grade news releases of gold intercepts within the next couple of weeks, and then continued drilling that will commence in June, which will sort of catapult us to start the feasibility study in the second half of this year. So definitely lots of news to come, Rob.
Yeah, feasibility studies, I just want to reiterate for everybody in the audience. I know they know because they watch us. Those are great news releases because it says, hey, this is what the project looks like. This is where it looks like the economics are, and that's where the bigger investors start getting really interested. It's where you may see some bigger institutions get interested. You may see some majors or mid-tier producers get interested. So if you guys are going to do a feasibility study this year, that's a great thing for investors to watch out for. It tends to really propel the knowledge and noticeability of your company, but also the valuation of your company forward. So if you guys are looking to do that this year, that would be a good entry point for investors who may be interested in you to get involved. And again, I just want to reiterate, we're in a rising gold environment. So a lot of the assumptions that are made on this project in terms of what we think the economics are going to be made at gold prices that are going to be much higher, I think, as an analyst in the future. And so when you get involved in these types of projects, you're talking leverage not only to the existing gold price, but to the rising gold price environment. Any last words for our viewers here, Scott, that you want to tell them about Canagold?
Yeah, maybe just to elaborate what you mentioned as we go through that transition from a preliminary economic assessment to a feasibility study. You're transitioning also from resources to reserves, and there's often a significant valuation bump when you make that transition. You can look at PNAV, but in this case, I'm talking about enterprise value per resource or per reserve ounce in the ground. we currently trade at about an enterprise value of $20 a resource ounce in the ground. But our peer average, if you were to look at it from a reserve perspective, is probably between $100 and $120. So to me, there's almost an implied 5x potential in our stock here as we make that transition and de-risk the resource and translate it into a mineable reserve.
Yeah, and the fact that you guys have a couple of different projects that you're looking at also is another thing that helps generate interest in a project. If you're just a single project company, those are great, but the multiple project companies tend to draw a lot of investor interest because you have that optionality in getting into longer term reserves, having a couple of different projects, and having optionality between the two different projects as well. So
yeah,
that's always a positive.
For sure, yeah. Besides British Columbia, we also hold a number of more grassroots exploration projects in Nevada that we often option out to other companies, which creates value for our shareholders. So we're definitely diversified there. We've probably got about 12 projects in our overall portfolio, where New Polaris is the flagship, and that's where we do spend most of our time and attention. That's where the real value comes from.
Perfect, Scott. Thank you so much for joining the program. We're happy to have you the first time on the program. We hope to see you again.
Excellent. Thank you very much for having me, Rob. I appreciate your time.
Absolutely. Wish you guys all the luck up there in Canada.
Okay. Thank you. Take care.
Thank you.